Yes, good evening, everybody. You're welcome to this section of our discussion. And the discussion will be centered around the part D of the financial management syllabus, which is business finance. Business finance. And under that, we are expected to look at sources of finance, cost of capital, sources of finance and their related costs. We are expected to look at capital structure theories and practical considerations. We are also expected to talk about finance for micro, small, and medium-sized entities. Yes, these are the components of the section D of the financial management syllabus. But for tonight, we'll pick one aspect of these components, which is sources of finance. Sources of finance. I will be discussing and sharing ideas as it relates to these aspects of the syllabus. So when we talk about business finance refers to the money and credit required for carrying out business activities, such as starting a business, running a business, and expanding a business. So it involves obtaining and managing or using funds efficiently to achieve the goals of the organization. So it is very important you match your source of finance to the need. When you need money for short-term purpose, you should know the source of finance that suits the short-term purpose in which you need finance for. When you need money for long-term capital projects, you should know the right point to source for your money. So importance of business finance is that it helps in starting the business. So capital is needed to purchase assets. Capital is needed to hire staff, to pay staff, and to cover initial expenses, because in business you have a growth, you have a business life cycle, and in business you have development stage, you have the growth stage, you have the maturity stage, and you have the decline stage. Each of these stage of business have their own cost component. So by the time you start a business, you're in the developmental stage, you don't expect to make profits. Yes, you get to a point, you begin to break even. You get to a point, you penetrate into the market and you occupy the market. You get to a point, you get to your zenith, to your peak point where you don't grow again. And once you don't grow again, it will get to a point you begin to decline in the market. So at that point of maturity, where you begin to look at the decline stage, what do you need to do? You begin to re-strategize on how to penetrate the market, on how to diversify the market. The concept of answer growth model that we usually discuss in performance management should set in at that point. So when you start a business, you need finance. You need finance, business finance, to run the business. That is for day-to-day operations. You need finance for working capital, to pay wages, to pay suppliers, to obtain or to pay for utilities likewise. And also you need business finance for growth and expansion, because once you start a business, you should be futuristic and look at a point where you ought to be, a desired point where you should be in the next 2 years, in the next 10 years. What is your goal? What is your vision? Yes. So you need finance to make sure you are able to achieve these targets. So growth and expansion need finance. So funds are needed for new projects. Funds are needed for new projects, entering into new markets, and acquiring new assets. You need finance for growth and expansion. And also, when survival becomes tough, you need adequate finance to sustain yourself in the market. So finance helps a business cope with losses, downturns, or emergencies when they arise. So you need finance in that situation. Also, Business finance is important for maximizing wealth because proper financing decisions ensure what we call profitability, and it also increase shareholders value. So most of what we'll be discussing under source of finance are what we've touched over time. Yes, such as factoring, such as invoicing. That is why I decided to bring this up so that we'll reflect back on certain things we've discussed, and let's see how far you've assimilated over time. So there are various types of business finance, which when you look at the syllabus, you see, and I know a group will be discussing more on that. Types of business finance: we have the short-term finance, we have the medium-term finance, we have the long-term finance, we have the internal finance, we have external finance, and so on and so forth. But I know the syllabus have streamlined us to certain aspects of finance we should talk about. So in simple terms, I would say business finance is the lifeblood of an organization because without proper funding, no business can survive or grow. So every business that wants to thrive in the market must be strategic and position itself in a way to source for finance that match its need at the appropriate time. So with this, we'll open the floor for various groups to talk. You have, depending, I don't know how prepared you are, at least you have a space of 20 minutes to give us an overview and get us convinced about the various concepts you'll be talking about as it relates to source of finance. So group one, you have the floor now.
All right, sir. Thank you very much, sir, for this opportunity. Good evening, everyone. I'll be talking on short-term finance, and as it implies, short-term source of finance are funding options of individuals, organization, businesses. They used to meet immediate operational needs and working capital requirements. Like as the name implies, short-term finance refers to funds acquired for within a brief period to meet immediate operational, which are the day-to-day needs of an organization. Some features of short-term finances are quick accessibility, working capital that is mostly needed for business to settle their working capital, which includes selling short-term debts and operation. It is flexible to assess the risks. It has low risks compared to long-term finances. These are just few features of the short-term finance. Then the short-term finance is within a short period of time, which is less than a year. The the we have some sources of short-term finance, and they include trade credit, bank overdraft, short-term loans, commercial papers, line of credit, factoring, invoice discounting, like our tutor earlier stated, as some of the topics we have discussed earlier, working capital loan, public deposits, inter-corporate deposits, accrued expenses, and deferred income. I'll just be brief with few. I think I could not prepare much because of some constraints. So I'll start with bank overdraft. We all know what bank overdraft is. Is a credit facilities. Is a credit facility that allows an individual or an organization, business, to withdraw exceeding its account balance. It is it deals with us addressing short-term cash flow gaps. That is, it will help them in their daily operation of business. Then we talked about a listed uh, trade credit allows a business to defer their payment for goods or services, most times within 28 days. It is a flexible and reliable source of financing. that helps manager that helps to manage cash flows. It also helps the manager to assess some of the products or services and not pay immediately. It is also a source of finance. Then we have factoring. Factoring, selling of account receivables to third parties for immediate cash. It is often a discount to enhance liquidity. Then invoice discounting. We have discussed it before, submitting invoices to financial institution or third party for immediate funding. They will help us with funds to help run the operational activities of the business. Which and this invoice discounting, the repayment is made. I'm stuck. Deborah will continue from where I stopped, please. Thank you.
All right,
Good evening, everyone.
good
Good
evening.
evening.
Yes, thank you so much for this opportunity, sir. So I will continue from where Afiniki stopped. So we are still under sources of finance. So I'll continue with long-term source of finance. So um, companies also needed long-term finance to buy big assets like land, building machines to support their long-term growth. So the main source of long-term capital are equity finance. We have debt finance. We have lease finance. So I'm going to explain briefly what they really mean. So for equity finance, they are money from shareholders to run the day-to-day activities of um, businesses in terms of getting these assets, buildings, machine, like I've stated earlier. So we also have debt finance. This is borrowing. Excuse me, sorry.
All right, as she's trying to come up, yes, you can do well to put down some things. Once you are ready to come up, just let me know. But I would like to add to what they've been saying in relation to short-term sources of finance. So when we talk about short-term finance or source of finance of funding is a way of funding, yes, required for less than 1 year. So and is mainly used to cover working capital needs by short-term source of finance. Now they talked about bank overdraft. The bank overdraft is an agreement with a bank to withdraw more money than is in the account, but up to an agreed limit. So it is flexible, but usually carries high interest rates. Yes, that is bank overdraft. Deborah, once you're set, just let me know. So also under the short-term source of finance, we also have the bank loan, which is also a short-term, a loan repayable within a year and is often used for temporary cash flow needs. That is the bank loan. The bank loan. And under that short-term source of finance, we also have trade credit. Trade credit. Are you set?
Yes, sir.
All right.
So I'm really sorry about that. Something came up. So As I was saying, we have equity finance, we have debt finance, and we also have lease finance. So equity finance comes from the owners of the company. It is ordinary shareholders. So it can be raised by issuing new shares to raise cash, issuing shares to buy another company. But the main source for most companies is retained earning. So internal sources of finance, which means retained earnings, part of the profit kept in the business instead of sharing everything as dividend. So I'm sorry, I just quickly prepare this. Sorry about that. So we also have lease. So instead of companies to buy machines, buildings with a huge sum of money, they might as well lease them, like borrow them, instead of spending a lot of money in buying uh, those things they needed for the business operation. So we also have long-term finance and working capital. Uh, I don't know what's wrong with my iPad. So long-term finance and working capital. A company can also free up cash by managing its working capital more efficiently. This can be done by reducing their inventory level, collecting trade receivables from their customer, or delaying payments to suppliers. This reduces the amount of cash tied up in daily operation and provide a one-time extra source of funds that can be used for investments in the business. So I'll be moving to private company versus public companies issuing new shares. So private companies cannot sell shares to the general public. Their shares are not traded on the stock market. They can only sell shares privately to selected investors, which is usually difficult. So the problems with private company shares, they had to have to sell what an investors wants their money back. So most small and medium businesses are private companies. They rely mainly on retained earnings, but profits are usually small, so funds are limited. So for companies, public companies can sell shares to general public. Their shares are usually traded on the stock market. So the benefit of being public is that shares have a recognizable market value. Shareholders can easily sell shares if they want cash. So, and requirements before trading shares on the stock market must meet regulatory standard, must provide transparent information to investors, and must be acceptable by the stock exchange. I'm sorry if I'm too fast. I'm just trying to brief what I have here. So we also have method of issuing new shares for cash. So company can raise money by selling um or issuing new shares, like I've stated before. So the three main methods are the public offer, the placing, and the rights issue. So So public offer is simply means when shares are sold to the general investing public. It is very costly, so usually done for a large amount. So when a company comes to the stock market for the first time, they often use initial public offering to raise funds. So then number two is leasing. So shares are sold to a small group of selected investment like institutions, banks, or investment funds. It is cheaper and quicker than a public fund. And the third one is right issue. I believe we are familiar with this third one, right issue. For those of us that are writing FR or that have written FR before, right issue. So it is when new shares are offered to the existing shareholders. So first, in the proportion to what they already owned. So this prevents dilution of ownership um, of current shareholders. So that is all I have to say for now because the remaining aspect of the um, presentation is calculation. So I did not prepare any slide to present that. Thank you, sir.
All right, thank you very much for that. Yes, they've talked about the sources of finance, that is looking at the short-term sources of finance that is available to businesses. And under that, we have quite a number of short-term sources of finance. Yes, and these sources of finance, these short-term sources of finance, I said they are most suitable for funding the day-to-day activities of the business, that is the working capital. So the funding requirement may be for each component of current assets and current liabilities, such as inventories, account receivables, prepayment, short-term investments, and accounts payables. So this source of finance is usually available for a period of 12 months or less. So short-term source should not be used to finance long-term business. Yes. So should not be used to finance long-term business activities such as purchase of non-current assets, because that may amount to funds mismatch, and can impair the repayment ability of the company. When you're using short-term source of finance to try to meet long-term capital need, there is a mismatch in that aspect, because the short-term source of finance is suitable for day-to-day running of the business. So we have quite a number of sources of short-term finance. Yes, we have things like trade credits, bank credits, that is overdraft. You can have things like commercial papers, back acceptances, bills discounting, invoice discounting. You can have other personal savings, loans from friends and relations. These are short-term sources of finance. And also, in some literatures, you can have things like short-term, medium-term, and long-term. Yes, but our syllabus have restricted us to issues of short-term and long-term. So under long-term, they actually talked about things like lease, lease. And when you talk about lease is simply an agreement between two parties, which is the lessor and the lessee. And who is the lessor? The lessor is the person that owns the asset. The lessor owns a capital asset, but allows the lessee to use it. So the lessee makes payments under the terms of the lease. Yes, because there will be an agreement. There will be a contractual agreement between the lessee and the lessor. So based on the terms of payment, the lessee will have to pay based on the specified period of time. So leasing is therefore a form of rental. Is a form of rental. So leased assets, I would say, are usually plant and machineries, can lease cars and commercial vehicles, and it might also include computers and office equipment. And more so, there are two basic forms of lease, which everybody should know. Yes, there are two basic forms of lease. We have the operating leases and the finance leases. Somebody will ask me, what is operating lease? Operating lease are rental agreements between the lessor and the lessee, whereby the lessor supplies the equipment to the lessee. And also, operating lease is a situation whereby the lessor is responsible for servicing and maintaining the leased equipment. Yes, once you rent an asset, you will be in charge of servicing and maintaining the equipment. And the period of the lease is usually a fairly short one, less than the economic life of the asset. So that at the end of the lease agreement, the lessor can either do what? Can either lease the equipment to someone else, yes, and obtain a good rent for it, or the lessor, or the lessee rather, or the lessor can either sell the equipment, yes, as a second hand. Yes. So that is operating lease. You should know that if you are doing FR, all these issues that always come up in that. And when you talk about finance leases are lease agreements between the user of the leased assets, the user of the leased asset. And who is that user? That is the lessee. And a provider of the finance. Who is the provider of the finance? Is the lessor. Because sometimes students can get confused. Who is the lessee? Who is the lessor? The lessor is the person that is providing the finance. Who is the lessee? Is the person that is hiring the assets, that will be using the assets. So let's take note of that. So one thing with finance lease, in finance lease, the reward and risk of ownership incidental to the lease assets are transferred to the lessee. Yeah, so the lessee is responsible for the upkeep, servicing, and maintenance of the assets. So the lease has a primary period which cover almost or most of the economic life of the assets, unlike the operating lease, which is just for a short period and you return back. The finance lease, sometimes when you operate a finance lease, you might use the assets for over time, even up to the end of the useful life of the asset. So they also talked about issues of equity, equity financing, equity financing. Now, equity financing is the investment in a company by ordinary shareholders, represented by issued ordinary share capital plus reserves. So ordinary shareholders are the owners of the company that contributed their capital to finance the operations of the company. So investors who purchase equity securities are seeking a total return, that is capital appreciation and dividend income. So that is their expectation. That is their expectation. So they talk about some sources of raising equity finance. It can be through retained earnings, it can be through right issues, it can be through new issues. New issues. All these they've discussed. I'll forward a write-up in relation to this to us, in relation to this to us. And I don't know if group two, can you have the floor now? Group two. Group two. Okay, good, fine. All right. Let me stop sharing mine then.
Hello, sir.
Yes, I'm there.
Yes, sir. Well done, sir. I have a
Thank you.
question as regards the finance lease.
All right, ma'am.
Yes, sir. I want to confirm the maximum period.
Okay.
The maximum period of the lease item, yeah, of the lease item between the lessee and lessor.
Now it depends on the
Maximum.
yes, it depends on the contractual agreement between both parties. Yes, is an agreement, is a contract between
Okay.
both parties. So it depends on what they've agreed upon. Yes, that this is the period that will be will need these assets. So there is there might it can be for a period of 5 years, and it depends on the nature of the asset likewise. Yes, there are some assets that the best period they can serve, their useful life can be 10 years. So when you are going into an agreement and you are using the assets for 10 years, for 9 years, for 8 years, it means that the agreement is no longer operating lease, because operating lease will just be like a form of hire. Let me use it for a day and return. But
Okay.
finance lease, once you are taking
Fine.
a large proportion of the useful life of the assets, it shows finance lease is setting in. Yes, and it's based on the agreement between the parties involved. There are some assets that, due to finance, a single organization might not be able to obtain it. Maybe there is somebody somewhere else that have these assets. Those in mining, it's not easy to get assets, to get the excavators by a single individual. So someone can decide, who is very rich, it might not be into mining, but can decide to invest in those equipment. People that needs it can come and hire, and they use it for period of time they're on the mining site. And once they keep using it over and over again, all they need to do is to fulfill their obligations to the
Okay.
owner of the asset. So depending on the agreement, man. So it varies.
Okay.
Yes. So, but
Okay.
question,
No worries, sir. Uh,
yes.
okay. So I'm so sorry, sir. The
All
reason
right.
that back up my question was that I came across a question in
All right.
respect of FR.
Yes.
So in the question, it was stated for 23 years.
Yes, ma'am.
So going through the solution, I
Yes.
observed that the solution maintains 15 years. So I kept on wondering that is it, I mean, the maximum year, is it 15, is it being pegged to 15 years? So that was why I asked this kind of a question.
All right, ma'am.
Mhm.
All
All
right.
right, sir. Thank you, sir.
All right. Thank you. Yes. Group two.
Okay. Good evening, everyone. Good evening, sir.
Good evening.
Okay, so we'll be speaking on Islamic finance. I mean, it's like this. Sorry, sir. Okay, we'll be speaking on the method of raising short-term and long-term Islamic finance, including the concept of riba and how returns are made by Islamic financial securities. And also, we explain the Islamic financial instruments available to businesses. So I will start with the terms Islamic finance. For my slide here, said Islamic finance research on the applications of Sharia. Sharia law is derived from the Quran and the teachings of Muhammad. Muslim believes that Sharia law shows the path to be followed as ordained by Allah. It covers all aspects of life, and Muslims believe that following this path will lead to physical and spiritual well-being. Islamic finance has the same purpose as other forms of business finance, except that it operates in accordance with the principles of Islamic law, which is the Sharia. The person, what's his name? Mr. Ikeoku. Okay, thank you. The following activities are prohibited, like in Islam. There's this thing called Sharia law, just like how we have the customary law. Sharia law guides the dealings of the Muslims. So in any activities that as a Muslim you want to do, you have to conduct if it goes in line with the Sharia laws. That happens to you have to conduct if it goes in line with the Sharia's law. So the following activities are prohibited: charging and receiving interest, like investing in some investing and receiving interest on some certain investments. In Islam, it is prohibited. We have this contradicts the principle that risks must be shared, and is also contrary to the ideas of partnership and justice. Using money to make money is forbidden. Investment in companies that have too much borrowing is also prohibited. What constitutes too much borrowing is a matter for interpretation, but is typically defined as debt totaling more than 23% of the stock market value over the last 12 months. Investment in businesses involved in alcohol, gambling, or anything else that the Sharia considered unlawful or undesirable, which is termed haram. Investment in transactions that involve speculation or extreme risks. This is seen as gambling. Entering into contracts where there is uncertainty about the subject matter and terms of contract. This includes a prohibition on short selling, that says selling something not yet owned. So we'll be looking at the concept of riba, which is interest. Islamic banks are allowed to obtain their earnings through profit sharing investments or fee-based returns. If a loan is given for business purposes, the lender the lender should take part in the risks. This usually involves the lender buying the assets and then allowing a customer to use the assets for a free. Riba is defined as the excess paid by the borrower over the original capital borrowed, that is the equivalent to interest on a loan. It's within the conventional banking system. A bank gets access to fund by offering its interest to depositor. It will then apply those funds by lending money on which it charges interest. The bank makes a profit by charging more interest on the money it lends than it pays to its depositor. This process is outlawed under Islamic finance. In an Islamic bank, the money provided by depositors is not lent, but is instead channeled into an underlying investment activity, which will earn profits. The depositor is rewarded by a share in that profit after a management fee is deducted by the bank. For example, in an Islamic mortgage transaction, instead of loaning the buyer money to purchase the item, a bank might buy the item itself from the seller and resell it to the buyer at a profit, while allowing the buyer to pay the bank in installments. However, the bank's profits cannot be made explicit, and therefore there are no additional penalties for late payments. In effect, the interest is replaced with cash flows from productive sources, such as returns from wealth-generating investment activities and operations. These include profits from trading in real assets and cash flow from the transfer of your right to use an asset, for example, rent. So moving to the Islamic instruments. The following Islamic financial instruments provide Sharia compliant finance. Often the cash flow from these techniques might be same as they would have been under standard Western practice. However, the key difference is that the rate of return is based on the asset transaction and not based on interest on money loaned. So under um, the financial instruments, we have murahaba, which is known as trade credit. We have Ijara, which is known as lease finance. We have Mudaraba, equity finance, Sukuk, debt finance, and Musharaka. So I'll be speaking on Murabaha. In traditional Western finance, a customer would borrow money from a bank in order to finance activity. Say the purchase of an asset. However, under Sharia, the bank cannot charge interest. Muharaba is a form of trade credit for asset acquisition that avoids the payment of interest. The bank buys the assets and then sells it on to the customer on a deferred basis at a price that includes a agreed markup for profit. Payments can be made by installments, but the markup is fixed in advance and cannot be increased, even if there is a delay in payment. Ijara. Ijara is the equivalent of lease finance. It is defined as when the use of the underlying asset or service is transferred for consideration. Under this concept, the bank makes available to the customer the use of assets or equipment such as plants, office automation, or motor vehicles for a fixed period and price. Some of the specifications of an Ijara contract include: 1. The use of the lease assets must be specified in the contract. The lessor, which is the bank, is responsible for the major maintenance of the underlying assets. The lease is held for 3. The lease is held for maintaining the assets in good shape. So now, moving on to Mudaraba. In Mudaraba, the banks provide capital and the customer provide expertise to invest in the project. Profits generated are distributed according in a predetermined ratio, but cannot be guaranteed. The bank does not participate in the management of the business. This is like the bank providing equity finance. The project might make a loss in this case. The bank loses out. The customer cannot be made to compensate the bank for this loss, as that would be contrary to the mutual sharing of risks. Mudaraba is a special kind of partnership where one partner gives money to another for investing it in a commercial enterprise. The investment comes from the first partner, who is called Rabulma, while the management and the work is an exclusive responsibility of the other, who is called Mudarib. The Mudaraba profit sharing is a contract with one party providing 100% of the capital and the other party providing its specialist knowledge to invest the capital and manage the investment project. Profits generated are shared between the parties according to a pre-agreed ratio. In Mudaraba, only the lender of the money has to take losses. This arrangement is therefore most closely aligned with equity finance. So, sir, my other person will be taking over from the Musharaka.
Good evening, everyone. I'll be taking off from Musharaka. Please, can you scroll the slide up, please? Musharaka is a kind of partnership. Those Islamic finance is what we are used to, is what we've read before. But just the time, we advise us to provide an acronyms so that we'll be able to get acquainted with those words, because so that we'll not be mixing it together. Musharaka is a relationship between two or more parties who contribute capital to the business and divided the net profits and loss pro rata. It mostly flows hand with concepts of venture capital. All providers of the capital are entitled and participate in management, but not required to do so. The profit is distributed among
capital contributions, and same as loss. We bear the loss and the profit and loss together. So that is all about Musharaka. So when you hear about Musharaka, know that the definition that will fit in is partnership. Anything partnership that comes to your mind is Musharaka. So Shukuk is a kind of Islamic financial certificate of an intangible asset. This is a debt finance, but Islamic bonds cannot bear interest. You all know that cannot bear interest. It can only bear profit, not interest, not riba. Sukuk holders must have an ownership interest in the assets which are being financed. Sukuk holders return to the providing finance in a share of the income generated by the assets. He will get his own share on how the asset is being performed, as in performing how the asset is being generating profits. That is where Sukuk holders get their own income. Modern Sukuk share many features with Western secu- securitizations. There are many different types. These syllables have limited us to, there are so many, but we have been limited to 4 types of Sukuk, including number 1 type of Sukuk. Can you scroll up? Type of Shukuk. Shukuk are Sharia compliant. Typically, Shukuk are certificates that represent ownership of an asset, which we said earlier on, or it instrufers refer to all the benefits that ownership of an asset will convey. Just an ownership of an asset. This section explains types of Shukuk, arrangements in more details. There are different ways in which each type of shukuk might be structured. The details of the structure might vary from those in the following explanation. Shukuk al-Ijra, a sponsor, say a business AS bank, which sets up a special purpose vehicle. SPV, which the purpose of buying an asset of business A, which will be later leased back to it at a pre-agreed price. This shukuk is just anything that will bring income to me, that will make the asset to generate bring income to me is just revolving around this shukuk. The SPV would issue ownership certificates, which is shukuk, to an investor for cash. Okay, I want to invest in your business. You will, while investing, you will give me a shukuk. You will give me a shukuk. And from that shukuk, for me to hold a shukuk certificate, that means the way that asset that I invested in is performing. That is why I will get my own profit, my own income. The amount raised will be amount needed to buy the asset of business A. So the next slide. Mudaraba shukuk. That shukuk al mudaraba. Business B, which to raise the finance for a major new construction project. This approach is to set up an SPV which would own the project and engage business B to run it. A sponsor, say business B's bank, would set up a special purpose vehicle, SPV, with the purpose of investing in the project. The next one is ownership certificates to investor for cash. The amount raised will be amount needed to be financed in project. Business B is contracted to run the project and will be entitled to a fee like a share of profit. On completion of the project, the SPV transfer ownership of the assets to the customer. And the fee, I'm not seeing the slide, sorry. Sorry, maybe it's in my network. I'm not seeing the slide.
All right, I think it's a network. Anybody else to pick it up? Anybody else in that group to say something regarding that?
Okay, if I may continue from where she stops. Um, she has spoken about the types of sukuk. So I will go over to the fourth sukuk that she was about to speak on, which is the Murabaha sukuk. The sukuk are Murabaha. Here in this situation, the business C wishes to raise finance to buy a large amount of iron ore. A sponsor says business C's bank will set up a special purpose vehicle. What I'm trying to say that maybe, for instance, a business wants to buy or want to finance to buy a large amount of iron ore, that is the raw material, natural resources. Then the sponsor of for business C, who wishes to buy the raw material, the sponsor of Mr. which is the business C's bank, will set up a special purpose vehicle. And the special purpose vehicle has just one purpose, which is buying of that ore. The SPV, which is the special purpose vehicle, will issue ownership certificate, that is the sukuk certificates, to investors for cash. The amount raised will be the amount needed to buy the ore. That point you can, in other words, say maybe like a collateral. The sukuk is like a collateral, a certificate to the investors. They give them that collateral to the investors. The investors release cash to them, to that target amount they needed to buy the iron ore. Then the SPV, that's the purpose of that SPV, which is to buy the iron ore. Once that cash is raised, the purpose has been fulfilled. Then the SPV then sells the iron ore to business C at a profit. Then the business C pays for the iron ore according to a pre-agreed schedule of payments. Then the last but not the least we're talking about is the Musharaka Sukuk, also known as the Sukuk Ag Musharaka. In this scenario, a business who wishes to raise, say a business D, who wishes to raise finance for a major new construction project, the business D will approach the bank to set up an SPV, which is also known as a special purpose vehicle, and to enter into a joint venture with the business. Now, the business D will provide the expertise needed to run the project, and the sukuk holder through the joint venture will provide the finance. In this scenario now, the previous one we spoke about, there is no joint venture. They don't have any collaboration of investors. But in this particular sukuk, there are collaboration of investors, not just one investor now. There are two investors coming together to form a joint venture to finance the project for business D. Then when they finance that project for business D will give them a collateral. As in other words, will issue them a sukuk certificate. Then the sukuk holders will participate in the management of the joint venture. And the profit and losses of the joint venture will be shared between the owner, the business D, who is the owner of the business, and the sukuk holders, who are the investors that came together to form the joint venture. And this is the end of this slide. So over to you, sir.
All right, thank you very much for that beautiful presentation. I don't know if there's any questions regarding these aspects. Some of us, maybe this is the first time we're hearing some of these terminologies. Those days in school, it was an elective course known as interest interest-free banking, and some of us went for inflation accounting, because we don't want to learn issues of interest-free banking, known as Islamic banking. So, any question? Acknowledge, your hands are up.
Yes, sir. Yeah, I want to ask. There are sometimes I perform a transaction with Jai's bank. It's supposed to be an interest, but the interest on their money is so high, and they call it interest, not like it's not an interest. But based on this topic, we were to share the profit and loss. It is risk bearing. We're supposed to share the loss together. Unfortunately, the business fold up, and according to this topic, to this class, the interest or profit generating supposed to stop, even though when the business loss, so that we can share the loss together. But on the other hand, it wasn't. The profits keep accumulating for the month of default of repaying the loan. But I don't know, was it that what they are practicing is quite different from what we're being taught, or this is just for learning sake? That's what I want to ask her.
Yes, they are supposed to practice an interest-free um, system. But do you have an account officer that you relate with regarding that?
Yes, sir.
And what is his response to your plight?
Actually, it was when I came across this topic that I know much about the effect of all those things, because they operate like normal banks to we business owner.
Okay, to you,
So
business finance.
yes,
Okay. No, I don't
I
bank
know.
with them, but
Is that
the general, I said, although I don't bank with them, but the general perceptions, I think I have some friends that bank with them, and they will tell me that it's very good, that they don't charge interest, they don't do this, they don't do that. So, with regarding to your own experience now, I think it will be good you relate with your account officer based on the knowledge you have now, so that he will explain better to you. Maybe there is, when you're trying to go into certain deal with a bank, you if you don't know the nitty-gritty, there are certain silent issues that will not expose to you. Yes, it is when you've entered into such um, contract with them, or you engage yourself in a loan, that is when you begin certain things will begin to surface. So, but with this knowledge, I think you should be able to ask quite a number of questions from your account officer on why they you are not sharing the loss with them, or they are not sharing the loss with you, and why they keep charging you interest even when there is the business have stopped. Yes, if I should get your question very well. So it would be very nice you relate with your account officer based on this knowledge that you have now. Yes, but I didn't get your response in regarding your relationship with the account officer.
thank you, sir.
What when you asked him question or her question, what is their response? Or you've not engaged them on this at all? Madam Janet. Okay. I think she's not she can't hear me
Sorry,
again.
my network is bad. Sorry,
Right.
I didn't
So,
get your
did you
last thing, sir.
engage your account officer on that, on the issue? I want to,
Yes,
what
we shall
is their
please.
response? The response.
They are even, they are not being considerate. That is just it. We have to drag ourselves to court. They are not being
Well,
considerate. Sincerely, they are not being considerate. So, think this is another thing that baffles me much. So,
okay.
yeah.
So it's an issue that is in court, and okay. All right. Thank you for bringing that up. So this is an eye opener. Yes. So that as you try to engage yourself with the popular notion we have about Jais Bank is that they don't charge interests, and they operate interest-free banking. That is the concept we have about them. But if there's anything contrary, maybe the customers we need explanation regarding that. Regarding that. So to give my own view about Islamic banking, I'll just give some little bullet points regarding that. That Islamic finance is seen as a form of ethical investing or ethical lending that is based on Islamic laws, that is Sharia. So Islamic finance is ethical, is equity based and asset backed, and it promotes risk sharing, yes, and connects financial sector with the real economy, and emphasizes financial inclusion and social welfare. So it is expected to be practiced once you are coming out that you want to operate an Islamic banking, interest rate banking. You should uphold the ethics of Islam, of Sharia regarding that. So the objective of Islamic finance transaction is that it is expected that the transaction should be true to the Sharia principles of equity and justice. That is it. So, Madam Janet, you can see it should operate based on equity and justice, and it should be free from unjust enrichment, trying to exploit a third party or another party just to enrich yourself. No, Islamic finance frowns at that, and it must be based on true consent of all parties. Anything that will transpire, every party should be in the know. Yes, there should be no any silent issue or any hidden issues as it regards to Islamic finance. Everything should be put on pen and paper, and every party should understand what they are going into. So this is very important as it regards Islamic finance. And Islamic finance is seen as an integral part of a real trade or economic activity, such as sell, lease, manufacture, or partnership. The key principles of the Islamic finance is interest. Interest, you must be able to know all these terminologies. Interest is riba, yes, and interest is prohibited on all transactions. That is the principle of Islamic finance. So an organization that is practicing Islamic finance must uphold this tenet to the letter, yes, and not try to breed it in any way. So its interest is prohibited on all transactions, and financing must be linked to real assets. Financing must be linked to real assets. When a bank wants to finance an asset, wants to give you finance, it means that finance must be associated with an asset, tangible assets that will withstand the test of time, either construction of roads. Yes, like if you look at most roads in Nigeria, you see Sukuk funded. It shows that the source of finance for constructing that road is from this form of Islamic finance, which is Sukuk, which is a form of certificate of ownership. Yes, a bond between the federal government and the bank. So if you travel around most countries, most of the states in Nigeria, you see some sections being funded by Sukuk. Yes, being funded by Sukuk. So when you're getting finance, it must be into real assets, real assets. So trading in arms and alcohol or pork is not permitted under this form of Islamic finance. So, and one thing with Islamic finance is that issues of uncertainty, gambling, is not associated with Islamic finance. Islamic finance frowns at it. It frowns at it. So we must know this as regarding Islamic finance. So there are various terms or basic instruments used as a source of Islamic finance, which they've mentioned. We have Murabaha, which is a cost plus financing. And when you talk about Murabaha, for example, I will say in Nigeria, let's say a company in Nigeria needs raw material worth 50 million, worth 50 million. So instead of taking a loan, the Islamic bank buys the raw material from the supplier at, let's say, 50 million, yes, and then sells to the company for 55 million. And most likely, we can say payable in 12 months. That extra 5 million is the bank's profit margin, not interest. Take note, Murabaha is cost plus financing. Cost plus
Plus financing.
financing. Cost plus financing. Cost plus financing. So please take note of that, please. And we have Ijara. Ijara, which they've explained that is just in form of lease financing.
Yes.
Lease financing. And this occurs when a bank purchases an asset such as motor vehicle, plant and equipment, etc., on behalf of a customer. For example, a transport company might want to acquire buses worth 100 million, but cannot buy them outrightly. So the Islamic bank can decide to buy the buses and lease them to the company at an annual rent of, let's say, 2 million for 10 years. So at the end, the company may have the option to purchase the buses at an agreed price. At an agreed price. That is Ijara. 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 There's something I don't want to murder the word now. That is Ijara wa Quinta. Yes. Ijara wa Quinta. Yes, so that is the word. I don't want to murder it. So we also have Mudaraba. Mudaraba. And this is a partnership contract in which one party contributes capital, while the other puts effort.
Yes, part.
Yes, yes. So for example, now you can be an entrepreneur and you have an idea to start, let's say, a food business, to start an eatery. Yes, but you lack the capital. You have the skills, but you lack the capital. So an investor, for example, an Islamic bank, can decide to provide 200 million as capital, while you, the entrepreneur, provides the management and the expertise, and the profits will be shared based on the agreed ratio. And if there is a loss, as they've mentioned, only the investor loses the money, while the entrepreneur loses what is effort and time. That is Mudaraba, equity finance. Mudaraba. Mudaraba. And we have what is that again? Musharaka. We have Musharaka. Musharaka. And when we talk about Musharaka, this is an arrangement where two or more parties contribute capital to a business and profits are shared according to a predetermined ratio and not necessarily in relation to their contributions, but losses are shared in proportion to capital contributions. Yes, based on what you contribute. When there's a loss, the ratio of your contribution is how you will bear the loss. Is how you bear the loss. But when it comes to profits, it will not be based on your contribution, but based on what you agreed upon. Based on what you agreed upon. In the case of Musharaka, so all partners or providers of capital are required to participate in the management and control of the business, and each partner is liable for the action of the others. So it is most closely aligned with the concept of venture capital. So when we say each partner is liable for the action of the other, it means when the other party acts ultra vires, acts contrary to the law, once you are being called upon, you must also show up. When there is a loss incurred by another party in the business, you are also liable. Your asset can be can be carried, can be disposed to offset the loss that the other party has incurred. That is why we said the parties are liable for the actions of the other in the case of musharaka. In the case of musharaka. So the fundamental principle of Islamic finance is that there is prohibition of interest, there is risk sharing, there is prohibition of speculative behavior, and there is sanctity of contracts when we talk about Islamic finance. Islamic finance. So talking about the next part is the Identify and discuss internal sources of finance. Group 3, I think you are set. You can speak now.
Okay, sir. Thank you so much, sir. So we are presenting on internal sources of finance. So can you hear me? I don't know.
Yes, we can hear you.
Okay, so internal sources of finance, it refers to the fund generated within the business rather than external borrowing or equity. So the importance is cost effective, is sustainable, and is strengthening the financial independence. That is, the company don't have to depend on external borrowing or for shareholders to bring in for getting debt financing to get in funds. So we have example, we have a short term, we have debt factoring, invoice discounting, working capital management, and sale of non-current assets. Then the long term, we have retained earnings and dividend policy decision. I will not want to bother more on this because I've noticed the first group I've discussed on debt factoring, invoice discounting, and working capital. So I'll go to the next slide. The retained earnings. It refers to a portion of profits kept back instead of distributed as dividends. The advantage, no repayment obligation, strengthens reserve and fund reinvestment. While disadvantage is limited to profit availability, may reduce dividends and potential shareholders' satisfaction. The efficient management of working capital. These are some of the example of internal source of finance. I'll just touch on that now. With the working capital, we all know that working capital is current asset less current liability. So we have a faster debt collection to reduce receivables and inventory management, that's just in time and lean methods, and negotiating longer credits with suppliers. That's on getting if you look at this, our cash conversion cycle, we see how the cash in and how the cash goes out. So we have the cash, we have the material and services we purchase with the cash. We have account payable that we are owing that we have to pay. This is where we pay the vendors or the payables, and we sell. Selling, we have accounts receivable that are debtors. So when they pay, we go back to cash. So this is a cash conversion cycle. We have the benefits of efficient management of working capital, free internal funds, and improved liquidity without external borrowing. Then the dividend policy and finance. Dividend is the reward to shareholder from profits. High dividend reduce retained earning, but low dividend increase internal financing. Balance needed between shareholders, reward, and business growth. So this is talking about the dividend, what it entails. So if you have a high dividend, that is, you declare high dividend to your shareholders, you reduce your retained earning. What it's trying to say is, let's assume that we make a profit of 5 million and we declare a dividend of 3 million. Our retained earning will be 2 million that will be retained for that year, which will reduce our dividend. Shareholders will be happy, but our retained earning will reduce with some percentage. So for example, we have a firm cut dividend during expansion. For many years, Amazon did not pay dividend to its shareholders, even though it was highly profitable. Instead, the company retained all its earnings and reinvested them into expanding operation, funding new warehouse, developing cloud services, and entering new markets. By cutting out dividend and prioritizing reinvestments, Amazon was able to grow into one of the world's largest companies, creating more value for shareholders through capital appreciation rather than immediate dividend payment. So in doing this is just what another internal source of funding. Instead of paying dividend, like what Amazon had done, they had to plug it back into the business to expand the business and also, at long run, give the shareholders more payouts at the end of the day. So the theoretical approaches to dividend policy. So we have the residual theory, we have the Modiglian-Miller and the bird-in-hand theory. So the residual theory is saying that dividends are only paid after profitable investment opportunity are funded. The implication for dividend policy: dividend payout is residual, reinvestment is prioritized. That is, they prioritize reinvesting the profits they get instead of paying out dividend to the shareholders. That's what residual theory is saying. Why the Gillian-Miller, it says in a perfect market, dividend policy has no effect on firm value. The implication to the dividend policy is that dividend and capital gains are irrelevant to shareholders' wealth. The bird in hand is saying that investors prefer certain dividend now over uncertain. It prefers certain dividend now over uncertain future capital. That is, the average shareholders want to get their dividend now. Pay me my dividend. Let me have my yield on whatever investment I've done. So the higher the dividends increase firm value as risk is perceived lower. So if, what bird in hand is saying, theory is saying, is that the investors want to get their returns on their investments. Just giving my return on my investment. I'm not ready to wait. Just like the example we cited, where Amazon had to invest the profit they made for that year instead of sharing dividend. But at long run, it was Amazon up to now. It's one of the biggest e-commerce business we know. So the tax preference, so shareholders may prefer capital gains due to lower taxes. Lower dividend payouts may be optimal. Sorry, it's not my laptop. I borrowed this one. So sorry. Lower dividend payouts may be optimal to maximize after tax shareholder wealth. So we have practical influences and legal constraints. Profitability determines capacity to pay dividends. While liquidity, a firm may be profitable but cash poor. Legal restriction: dividend must be from distributable profits, not capital. Market condition and shareholder expectations. Stability of the dividend signal financial health. For example, during 2016 recession in Nigeria, we are trying to explain the impact of legal constraints on during 2016 recession in Nigeria. First Bank of Nigeria faced serious challenge that directly shaped its dividend policy. The bank recorded profits on paper but was weighed down by rising volume of non-performing loans and foreign exchange difficulties, which limited real profitability. Liquidity was also strained because cash flow was affected by loan default, even when marginal profits were declared. At the same time, the Central Bank of Nigeria introduced restriction preventing banks with weak capital position and high non-performing loan ratios from paying dividends, creating a legal barrier to distribution. Shareholders who had grown accustomed to steady dividend were disappointed when the bank cut or suspend payouts. However, this decision preserved liquidity and ensured compliance with regulatory rules and protected the institution's long-term financial stability despite short-term dissatisfaction. I hope we understand, because this is talking about policy that guide, like for banks now, that guides their loan payouts and recovery. So, and if you see, like First Bank, that they were about declaring their dividend, but looking at the financial aspect, the FX, they were good to declare dividend. But if you look at the policy that guides they are giving out loans and recovery of the loan, the time and how liquid they are, going with the policy that guide banks. They were not meeting up with the legal requirement. So this is another reason why this can also pose reason why they cannot pay out um, dividend at that time. So we have alternative to cash dividend. We have stock dividends, that is bonus shares, extra shares issued instead of cash. So instead of giving them cash, you can sell shares so that they can own more shares or buy new shares into the business instead of giving cash. So you can also share buyback, company repurchase its shares, boosting values, and script dividend, choice between cash or shares. Property dividend, they are rare but paid in assets. In conclusion, internal financing is vital for sustainable growth. Retained earning and working capital are key drivers. Dividend policy requires balancing theory with practical realities. Legal, liquidity, and shareholder concern must be carefully managed. Recommendation: maintain efficient working capital cycle, adopt a balanced dividend policy aligned with long-term goals, and consider alternatives to cash dividend when liquidity is tight. Thank you, sir.
Thank you very much. Thank you very much for the wonderful presentation and for taking your time to show us the beautiful slides. It's very nice. Thank you very much. That's any question regarding these aspects of identifying and discussing internal sources of finance. We have retained earnings, we have working capital management, relationship between dividend policy and financing decision. And also we have the theoretical approaches to and practical influences on dividend decisions. Though from our discussion, she is already linking us to the next aspect in terms of cost of capital. Because in cost of capital, as we move ahead to look at various theories, we'll be talking about the concept of Miller and Modigliani. They propounded quite a number of theories in relation to tax, when there is tax and when there is no tax. So the Miller and Modigliani will lead us in computing what we call the weighted average cost of capital as we proceed in the course of our discussion. Now, as it relates to the internal sources of finance, that is, how can you get finance within your organization? Within your organization, what are the methodology, what are the approach you can use to source for finance within your organization? As it is being highlighted in the syllabus, one is retained earnings. And when you talk about retained earnings, these are undistributed profits of the company that is attributable to the equity holders. So they are internally generated funds retained in the business to cater for the financing needs of the company. So for a well-established company, retained profits may represent the most important source of finance of both short and long-term purposes. So internally generated fund is easy and cheap to raise because it does not require any transaction cost, issue cost, or professional fee. So this source of finance may not be sufficient, especially when a huge capital outlay is required to undertake viable investments. So, and with the issue of technological innovations, most organizations want to move with trend, and for you to acquire some highly sophisticated equipment that's to be in line with trend, you need huge amounts of investment in these innovations, to meet up with the expectation of with reality. So retained earnings are profits kept in the business instead of being distributed as dividends. So they are cheap and flexible. But what it does is that it may reduce the shareholder satisfaction, because some shareholders, they want huge amounts of dividend now, because the more retained profits you have, the less amounts that will be available to shareholders for distribution as dividend, as dividend. So they also talked about the issue of efficient management of working capital. We've talked about this in some of our discussion over time when we're talking about balancing of liquidity and profitability. So is the concept of efficient management of working capital is that it aids in optimizing receivables, payables, and inventory to free up cash for financing. So how do you manage those components of working capital? How do you ensure that you don't keep too much cash? How do you ensure that you don't keep too much stock? And trying to balancing each of these components of working capital. So we have talked about the concept of dividend policy. Every organization is expected to have a dividend policy, because a lower dividend payout means that more retained earnings for investment, as I've had earlier mentioned. And when you pay high dividend, it means it reduces the available fund for financing internal issues. Internal issues. So the more dividend you share, the less retained earnings you have. The less dividend you share, the more retained earnings you have. And the more you have retained earnings, the more you have money for expansion, the more you have money for business growth. And in the long run, you have more dividend to share, because your business, as it expands, you make more profit that will be distributed in the future in form of dividend. And also talking about the theoretical approaches and the practical influences on the dividend decision, such as legal constraints, because this issue of legal constraints, dividend can only be paid from distributable profits. Yes, that is the law. It is when you made profit after deducting all expenses, what is left you distribute as dividend, So it can only be made from distributable profit. So what is your policy in form of dividend? What is a percentage of your profit you have to retain? What is left is what will be distributed as dividend. Also talking about liquidity, the point is this: even profitable companies need cash to pay dividends. So there must be a balancing in terms of liquidity and in terms of profitability. In terms of profitability, so there must be a balance, and see how much cash you need, how much you need in your bank to distribute to your shareholders in form of dividend. So the shareholders' expectation is that there should be stability in the business, and their dividends should keep growing, That is the expectation of the shareholders. So talking about the alternative to cash dividend, some organization, instead of distributing dividend to sending money to their shareholders account in form of dividend or giving out cash as dividend, there are other ways in which dividend can be distributed: through share buybacks, through bonus share, through scrip dividend, and the rest of it. So these are ways in which dividend can be given instead of actually crediting the shareholders' accounts with a particular sum of money. So the organization can decide to issue bonus share. Bonus share can be based on pro rata. Those doing FR, and if you've studied accounting, will be used to this. When you issue share based on pro rata, based on your existing share, maybe 2-for-1, 1-for-2, things like that, in a ratio. So instead of giving back cash or crediting your accounts with a stipulated amount, you can decide to give you bonus likewise for every shares you have, and you can decide to do what we call share buyback in an organization. So, any question regarding this, or anybody have something to contribute based on what we discussed, based on the various group presentation? In any group, you just want to add one or two things. This is practical. Maybe you work in a finance um, organization and you do some of these things, can share your practical experience with us, and we'll be glad we did. Yes, the floor is open, please. Yes, let's talk, please.
Oh, good evening, sir.
Good evening, ma.
Okay, talking about internal um, source of financing a company for like an NGO where I work, they do normal trainings. Normally, our source of financing is donations and contribution from donors, but now we do trainings to some researchers and other scientific trainings. So the fund from those trainings are an income to us, and it helps in helping the organization acquire some other thing. So that's my contribution.
All right, thank you very much for that. Yes, so those donations, they are externals. External, is it from certain countries or from
Yes,
certain?
donations are external, but the trainings that we do are internal.
Okay, so those forms of donation that are external, is it um, from certain individuals in the society or some set of organized organization, international organizations?
Okay, some are international, some are within, based on the project. Like we are is a scientific NGO, so they carry out research on some medical areas. So it can be external, I mean, from foreign donors or within the country.
All right, thank you very much for that contribution. Yes, any other person? Yes, share your experience. You have a personal business. Tell us how you source for fund. I know most people, most of you are females here. Some of you have side hustle business. You do business. And most of you don't depend on your salary. And some of you don't even earn salary. You do business. Mm. So share your experience, please. Madam Tolani, you don't have a business. Or you have an NGO too. Okay. Nobody's talking, right? The absence of stories. This is it. Take down these assignments.
Yeah, in fact, I'm so sorry. I just joined the meeting now.
Okay, I said you should share your experience with us.
Okay, as regards what, sir?
As regard internal source of finance, I said you might have a business, I said most females, you do side hustles. You understand? Some of you sell Ankara, some of you sell lace,
Ah,
some of you sell
yeah.
perfume.
Meanwhile, I'm not an entrepreneur for now.
Okay, okay. Why are you
But
looking for?
notwithstanding, in fact, they've said it all. The three groups, in fact, they really perform excellently. beyond someone's expectation. Honestly, I give kudos to them all. Thank you, sir. They've said it all.
All right, thanks for that beautiful evaluation and assessment. All right, sir, Mr. Don William.
Okay. Thank you very much, sir, for the opportunity and also for the learning experience. It's been a worthwhile. My question goes like this. Nigeria is a multicultural, diversified country, right?
Yes,
So
very well, sir.
can someone from the East have access to the Islamic banking and its corridors?
Very well, sir. It's very open. Very open.
Do you get my
to
question?
Yes, very well. I get a question that is Islamic finance biased? Yes, I get your question. Yes, the point is you're trying to raise a point that is Islamic finance biased regarding to ethnicity, regarding to a particular region. Yes, that is your question. Islamic finance is internationally recognized. As a matter of fact, the fact that it is internationally recognized, when you go to ACCA Park, do you understand? You see Islamic finance there. So it is open to every individual. Yes, it is. They don't discriminate. We have Christians banking with Jais Bank. Yes, we have various set of persons banking with, so you can access their facilities. So they don't discriminate. They won't ask you which religion are you. Is in Nigeria we ask religion before we give somebody an opportunity. In the Western, in the advanced or developed nations, even in your CV, they don't want to see religion. In your CV, they don't want to see your age. What they want to see is your skills. Is your skills. Yes. So Islamic finance is not biased about your religion. It's not biased about your ethnicity. It is open to every individual. You can access their facilities as long as you're interested in it. So that is it with Islamic finance. So it is recognized globally. Globally. Yes. I hope you are fine, sir, with this.
Yes, I am. I am.
All right. Thank you very much. So I want to appreciate everyone for keying into this. The essence of this is to make us have retouch of what we are learning, and at least when you do research, that research you are doing is to stick to you. Yes, to stick to you. That is why some of us that attended schools, that our lecturers will just come to class 2 weeks to exams, and they will do fire brigade and keep us in class. Most of us decide to learn on our own. Yes, we learn on our own, and that's research skills has been with us. So that is why, since this is a discussion topic, yes, I decided that I've been thinking about that over time since last week. Should I make it a group presentation or not? So, but yes, some factors push me, yes, this morning to decide to come up with this concept. So please, I'll forward a note regarding this, and do well to read. Yes, all these riba, all those concepts, please try and know the difference. It's very important. Yes, because they can ask you questions, and factoring too is another point that I want us to actually read and know very well. So I have a question, I have an assignment. I would just want you to note. Yes, let me come up with it. Is an examination question from SFM. So don't think I'm not just coming up with it. Every question I'm dishing out will always be past exam questions that have been tested. Yes, that have been tested. Yes, in either SFM or FM from ACCA Park. Yes, but this I will be giving out is from SFM related to this topic. Related to this topic, it can be very easy. The question can come very easy because you don't know the examiner's mind there, because you might undermine such form of questions. So the question is this. I think I have two questions. Okay, I think I have two questions. Let's see. Now, number one is this. Evaluate 5 factors. Evaluate 5 factors. Let me put it down likewise. Assignment. Assignment. It might require you to do research again. Evaluate 5 factors. Is a past question that should be considered. That should be considered by an organization. By an organization when formulating a policy for credit control. I think we discussed this when we're talking about credit worthiness. Yes, for credit control. Yes, they can come up with a question in this form for credit control. And also another question is on factoring. Another question is on factoring. Let me see if I can come up with a question on factoring. Question on factoring. Because examiners will believe students might not take their time to study this part. They might not give much attention to it. Yes, another thing, though we didn't talk about it, but I'm seeing it. Conditions. Let me just do your research on it. Conditions for listing. These are some of the things we treated in commerce in secondary school. Conditions for listing on the Nigerian stock exchange. What are those conditions on the Nigerian stock exchange? Conditions for listing. That is, if you have a company, what are those things you must fulfill if you want to be listed on the Nigerian stock exchange? So talking about factors now, the question is state 5 potential advantages. 5 potential advantages and 2 disadvantages. Of using the services of a debt factor by a business organization. So this is also a question. Now, another question is this. Factoring Factoring is one of the popular ways of managing accounts. Is one of the popular ways of managing accounts receivables. In corporate organizations. The question now is, when should factoring be used for debt collection? This will spur you to read more now. When should factoring be used for debt collection? There is something likewise. I don't know from your research if you've come across it. The question is this: briefly explain each of the following. Factoring terms. Some of these things, depending, you might not see them in your study pack, but the examiners, they've been setting questions over time. They can just go to their archive and just pick one of these. So that is why I'm coming up with them. Briefly explain each of the following factoring terms. Full service non-recourse. What do you say? What is this? Full service non-recourse. And full service recourse factoring. If you check one of my notes, I think this is there. One of the notes I forwarded over time when we just started this course. Full service recourse factoring. If you've been reading, you will have come across it. And we also have non-notification factoring. You know, some of you are just piling up those notes, waiting for when the exam will come close. Non-notification factoring. So we have to explain this. May I have the whole answers already here? Yes, so it's just you now. Do your own research. Yes, may I have the answers? Do your research and let it stick to you. I have my answers already. So what else can we ask again? What else? Okay. So these are some of the questions for now. But overall, understand what we've discussed in form of Islamic banking, source of finance, and the rest. Questions will come. I'll bring question from it. So, and I think that will be all for now. Tomorrow, I'll do videos on some of the topics that I'm here to send the videos. But tomorrow, I want us to look at cost of capital. It is very important you start learning those things now, because the exam is here. Cost of capital is it will come in the exams, so there is no story about it. You see it, you see questions on it, so you must know it. Which is the next thing? Cost of capital. We'll be looking at dividend growth model. We'll be looking at the systematic and unsystematic risk. All these are very important. I have my slides already I use for SFM class, so they are all related to this. So that will not be an issue. So we'll see how we talk about that. We start the introduction tomorrow so that we get used to most of all these things as early as possible. As early as possible. Yes. I'm talking about WACC, CAPM, capital asset pricing model. So see how we move. God will help us and grant us understanding. In Jesus' name. So please work on this assignment. I want to see your solution. Yes. When you send your solution, I'll now send my own to you. When you credit me, I'll debit my own account and give it to you. Yes. So thank you very much. Thank you very much for your time. Any observation?
Thank you, sir.